Lyn, as you know, several weeks ago, Treasury Secretary Janet Yellen has issued a plea to Congress to raise the debt limit. Her quote is as following: Defaulting on the national debt should be regarded as unthinkable, she said before a Senate hearing. And she said that failing to increase the debt limit would have absolutely catastrophic economic consequences. It would precipitate a financial crisis. It would threaten the jobs and savings of Americans, and at a time when we're still recovering from the COVID pandemic. So could the unthinkable be possible this time?
Well, it's technically possible each time. It's just one of those things that, pretty much by definition, it's a very, very low probability event. And if it were to occur, it would probably occur briefly and then be rectified. However, for example, some of the things that happened in say the capital of the U.S. earlier this year were previously thought unthinkable, and they still happen. So, investors have to watch out for these kind of tail risks that can happen. But in general, since the debt ceiling was implemented in the early 20th century, it's been raised something like 100 times, and so by both parties, and it's just it's historically been mostly a non-politicized event, but in certain periods of time it starts to be used as a tool, and so the way the debt ceiling works is you're not raising the debt ceiling for new debt. You're raising it to basically pay existing obligations that they've already signed into law, right? So it's not about new spending. It's about maintaining ongoing spending that they've already allocated. So it's different than, say, a fiscal stimulus bill or something like that. And so in some ways, it's philosophically counterintuitive to fight over the debt ceiling because, they already obligated that spending. But on the other hand, they use it as a practical tool to try to get something, from the administration when, because it's basically a strong bargaining chip. It's kind of like playing chicken.
The equity markets are largely dependent on policies going forward. So let's break it down, because you covered two different things: fiscal policy and monetary policy. So let's start with monetary policy first. So is it necessary for the Federal Reserve to raise interest rates anytime soon?
Well, it depends on what their goals are. So again, my base case is that they're going to see inflation and not really raise interest rates. So right now, for example, CPI year over year is about 5%, and they still have their interest rate policy at zero, roughly. And so, that because of base effects rolling off, we're probably going to get under 5% pretty soon. But I still think that, longer term, we're going to have impacts from rising wages, from energy prices staying somewhat elevated, and then potentially from rents kind of catching back up to some of the home price action we've seen. And so I think that, in some ways, some of the base effects are transitory, but some of the actual inflationary effects are not. And I think the Fed is, going to be very persistent at holding rates at a very low level. Even if they do some of these very small rates that they're kind of forecasting now, 50 basis points, that's still well below the prevailing inflation rate. And so I think, going forward, they're probably just going to stay at that point. And so that helps make the debt more serviceable, but also, weakens the currency in real terms. We also have kind of different philosophies out there, among policymakers. So there's kind of the MMT approach that some policymakers are adopting, and in general, if you look at some of the policymakers, what they've written, this has been kind of known, and so they seem to be aware that this is essentially a monetary issue, and it affects both the fiscal budget and the currency, and so I do think that there are different policymakers aware of it, but they don't really have a lot of tools at this point to deal with it, because if they try to close that gap, that would impact a lot of financial assets, which ironically, because the United States is so financialized, that would impact GDP, most likely consumer spending and GDP. On the other hand, if they let it run hot, then they risk kind of an acceleration of currency devaluation. And so they're kind of at this point where they have to pick their outcome, and both of them have consequences.
Okay, so Lyn, we know that the U.S. could technically raise the debt limit, but the problem is whether or not they could actually afford to raise the debt ceiling. This question has been posed to Jerome Powell before, whether or not we can afford it. At $30 trillion of gross national debt, we have the highest debt on record so far.
So again, the debt ceiling is about funding that's already been allocated. And so the real question has to be directed to: can we afford further stimulus? Can we afford these kind of structural budget deficits that we have? And so those are kind of two separate debates, because one is about kind of fixing forward spending patterns, and the other one is about paying for previously allocated funding patterns. But going to the bulk of the question, the short answer is no. Basically, at 30 trillion in debt, 5% interest rates, as you pointed out, that would be one $1.5 trillion in interest payments, which is a very large percentage of both GDP and specifically of government revenues and government spending. Now, there's a couple nuances there because that refers to the average of debt outstanding. And so that would
Yes.
include from the federal government, that would include short-term like T-bills as well as that longer-term debt. And so that would depend on basically some of those long-term low interest rates have already been locked in. But there is a very, very large percentage of the treasuries that actually consists of short-term T-bills. Last I checked, well over 10 trillion was that very short-term number. And so that basically is tied to the Federal Reserve's interest rate policy. And so the short answer is my base case for a couple of years now is that, this looks a lot like the 1940s in the sense that that's the last time that U.S. debt to GDP was as high as it is now. And basically what they had to do back then was lock interest rates at a very, very low level, even when you had these bursts of inflation. And that's because they found themselves basically fiscally in a problematic space. And so the downside there is that if you're holding cash or holding bonds, you can fail to recoup your purchasing power during that period. And so that's actually one of the big differences with the 70s and the 40s is that in the 1970s, private and federal debt as a percentage of GDP were both pretty low. And so when you had inflation, you could raise interest rates to combat it. Whereas in the 40s, when you had very, very high public debts, despite inflation, pretty much whatever you do, they couldn't raise interest rates. And so that's generally a pretty good case for holding real assets at this current time because I think we're still on a path towards currency devaluation. And it could happen in bursts or it can happen just over the course of a decade of having interest rates that are below the inflation rate.
So Lyn, if you compare the US debt to GDP to that of foreign countries, for example, Japan, it's actually not that bad. So for example, the US has a debt to GDP of roughly 100%, 105, depending on the source. Japan has twice that, 237%, according to the source I'm looking at. So is debt to GDP or aggregate debt an issue for you as an investor? Is that something you consider when picking jurisdictions across the globe?
So certainly one of the variables that impacts currencies and other issues like that. And there's a few variables to consider. So one is whether or not the country controls the currency that it owes the debt in. And so I'm actually more worried about some of those Southern European countries that have very high sovereign debt to GDP in a currency that they can't even control. So that means actually nominal default risk is potentially higher because they're reliant on the ECB to basically make their debt serviceable. Japan's an interesting case because they have the highest sovereign debt in the world as a percentage of GDP, but they control their own currency. And if you look at, for example, a lot of this debt kind of came out of the corporate sector. So, 20 years ago, Japanese corporates were very, very leveraged. Whereas now that's kind of shifted over to the sovereign level where they're corporates, they actually have as much cash as debt on average. Basically, if you look at kind of the broad index. And so actually, I find Japanese equities to be reasonably attractive, whereas basically Japan's public finances are another story. And so basically if you look around the world, I just kind of, did a report where I looked at over 30 countries, for example, at their different debt to GDP ratios, both for the sovereign and corporate and household levels. And you see kind of pockets of bubbles in different places. So some countries have housing, basically consumer debt at very high levels. Other ones have sovereign debt at very high levels, and other ones have corporate debt. And so, overall, depending on what I'm focusing on, if I'm focusing on equities in a country, for example, I'm more interested in corporate debt than I am at sovereign debt, unless it's one of those countries where they don't even control their own currency, and then you have risk of a financial crisis.